It's Friday Coffee with your mortgage man, Eric, baby, and it's been a while, hasn't it? So, got quite a bit to get caught up on. My apologies, man. I've been out. I've been busy with a lot of the end of the refi boom. We'll talk about that. Busy with my son's wrestling tournaments, man, and y'all know what's going on with the pandemic, and it's hard to get these kids into sports. So we're taking every chance that we can when we have that opportunity. Nonetheless, let's get into business. So hang on, and we got some huge topics to talk about, right? The market. What's going on in the marketplace right now with buying these homes and the overbidding processes? What's going on with interest rates right now? A lot of people are just not in the loop with the rates going up and how quickly they're going up and why they're going up. Hang on. And lastly, what did Fannie Mae, Freddie Mac do this past week? Introducing hits or increases to the interest rate that are already increasing for people that are purchasing vacation homes or second homes. They're synonymous, and investment properties. And we have a significant housing shortage here across the country, across this United States of America, that almost everywhere is facing the same situation. There's not enough homes. So let's dial it back. 3 huge topics. I'm already apologizing for the length of the video, but 3 very, very important topics. Let's dive in. Let's talk about the one right now, the market, the Arizona, the Phoenix metropolitan market, what's going on. And look, it isn't much different than in other places across this nation with the overbidding. You list a home for $350,000, $375,000, $400,000, and you're getting offers on it for $20,000, $25,000, $30,000 over the asking price, right? And that's common. Now, if you look at the Phoenix metropolitan area as a whole, you can start to see some pockets, right? Scottsdale might be a little bit more than $30,000 over asking. Gilbert might be a little bit more over 30. Mesa, Chandler, Tempe's probably 20, 25, right? Glendale might be 10, 15. You know, you may have to go to your outer lying areas, Florence, Eloy, Coolidge, Maricopa, Tolleson, those type of areas to only have to overbid or five to 10,000 over, okay? Now, what does that mean? And here's where people are missing the boat. Oh, well, we'll overbid. Not a problem, we'll pay more for the property. But you don't understand. When that appraisal comes in low, and we all know it's going to come in low, listing agent, buyer's agent, the lender, we've all, the buyer's agent and the lender has had a conversation with the buyers about this and say, look, here's what happens when the appraisal comes in low. You're going to have to come out of pocket with that difference. And so that conversation's happening, but some of these buyers are missing it or forgetting that piece of the conversation. So what happens? Somebody calls in, wants to get pre-approved for a home loan, right? Here's where we go. Do you have the down payment? Yes. Check. Do you have the closing costs? Check. Do you have the $10,000, $15,000, $20,000, $25,000 extra that you're overbidding? Because that's your responsibility. It's not the lenders. It's not the sellers. It's not some fictitious number gets put on paper. When the appraisal comes in, that's what we lend off of. So the difference between the appraised value and the purchase price you have agreed upon, that difference, the variance, you also have to come out of your pocket with those monies. That's huge, right? What does that do? That eliminates a lot of the first-time home buyers. That eliminates people that are trying to use down payment assistance program. Because look, if you're using down payment assistance program, you don't have the money. You sure as heck don't have the $10,000, $15,000, $20,000, $25,000 to overbid on the home, right? So it is a very, very unfortunate thing that's going on right now, and it's continuing to go on. It can't sustain itself for a long period of time. We know that. But the $1 million question is, how long? 2 months, 6 months, 9 months, a year? How long will this behavior last? And that's very concerning, okay? Keep in mind, that's the third topic we're going to talk about, some of what's being done to curb that behavior. Now, us in Arizona, we believe that some of that behavior will be curbed or tempered once California starts lifting its regulations due to the pandemic. Because what we're seeing right now is people flocking from California, leaving in droves, as they say, to come to Arizona. Because Arizona is open more than California, right? And there's a number of reasons why people are leaving California. High taxation, income, cost of living, right, et cetera, et cetera. But when you add the closures down, I talk to parents at these wrestling tournaments that these parents are bringing their kids to other states so they can get activity, so they can get reps, so they can be involved with athletics in their short childhood time period in life. And break it down even further. California has the most scholarships that they award, naturally speaking, biggest state, most high schools, but they have the most scholarships out of any state that they award to colleges, or colleges award to them, right, in high school. Well, when your high schools are shut down for football and basketball and wrestling and tennis and golf and on and on and on, there's no scholarships being given to these children, which is very, very unfortunate. Who's really missing out, right? It's these kids. They're missing out on opportunities to better themselves, go on to higher education, families that can't afford to send their kids to higher education, and they were counting on that scholarship, right? And now all of a sudden, oh, sorry, done. We're done. So what's happening, what we've seen is Californians moving to Arizona for yet another reason. Simply, they put their kid into scholastic athletics so they can have a chance at a scholarship. So that's why we're saying once we see it temper down in California, things open back up, we're hoping to see that temper, the people leaving California and coming here. Please, we hope that settles down and stops. It'll never stop completely, but you understand what I'm saying. Because the overbidding is created a lot from them, right? If you have $1 million home in Irvine, California, that's 1,200 square foot, right? You sell that, you come here, you have all of that money, overbidding $30,000 for you on a $350,000, $450,000 home is nothing. That's what's happening. That's extremely an unfortunate situation it has created for, again, low to moderate income families, first-time home buyers, down payment assistance program buyers. They are left in the lurch right now. Very unfortunate. Sorry, like I said, this is going to be long. Moving on. Interest rates. Where are interest rates? What is going on? Well, we've been warning people for a long time on a couple different things. One, interest rates can't last that long in the twos. I mean, come on. 2.5%, 2.6%, 2.7% on a 30-year fix with 0 discount points. Now, there's another topic, right? There's so many lenders, big banks, brokers, bankers that are advertising rates, and then, well, it's with a 40% down payment, and that's with 1.3% origination fees. It's like, well, are we back in the subprime days? Well, with some of the advertisement that's going on, unfortunately, we are. So you have to be careful as a consumer to not get caught up in that. Well, I saw a rate online. It said 2.75%. I can still get that, Eric. Yeah, with 2.25% discount fees. Well, that's a discount to me? So you know what I mean? They don't understand. No, that's an extra $9,000 in closing cost. You see where I'm going with that? Anyhow, rates going up. We knew that they were going to go up. We knew they couldn't last that long for a number of reasons. A healthy economy does not have interest rates in that range. It just doesn't. Additionally speaking, The $1.9 trillion stimulus package, we knew, look, economists knew, and were screaming from the top of the rooftops, right? That if you pass this large stimulus package, we will have inflation. And when we have inflation, one of the things that happens are mortgage bonds, mortgage-backed securities will increase their margin. It naturally happens, which means interest rates go up. We knew it was going to happen. So you can't have your cake and eat it too, whatever the heck that means, but it's a cliche, right? But you can't have it both ways. You can't have all the free money, all the free stuff, and then expect interest rates and inflation to stay low. That gallon of milk, that combo meal at McDonald's, those things at the grocery store are going to cost you more. That gasoline is going to cost you more now. It is what it is. Study some economics, stimulus package, inflation. That's where rates are going. We're into the threes, well into the 3% ranges. Now, hold on for the last thing, the third, probably the most important topic. That's why I save it for last. I hope that you tuned in here with me. Third, final thing is what Fannie Mae, Freddie Mac passed earlier this week that sent out shockwaves. Now I sound like a reporter. Shockwaves were sent out across the industry in regards to Fannie Mae, Freddie Mac's new release on LLPAs, loan level pricing adjustments on vacation homes, second homes, and investment properties, right? LLPAs, loan level pricing adjustments. We call it a matrix, we call it a tier, we call it a bucket system, right? Some people may know about this, right? The higher the credit score that you have, the lower the interest rate. The more of the down payment you put on your home, the lower the interest rate, and vice versa. It's called a matrix or a bucket system or a tiered system, okay? Everything has a risk. The less money you put down, the higher the risk, the higher the rate. That's how it goes. That's why we always say you have to read the fine print when somebody's quoting you an interest rate. You just can't pull up online, well, Eric, it says right here that the 30-year fixed is blah, 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 blah. Really? It takes up to 17 different components to properly and accurately quote someone an interest rate. Did you know that? 17 different components. Right? I mean, it's not just a click of a button. You just can't do that. Anyhow, loan level pricing adjustments. Fannie Mae, Freddie Mac came out and announced, look, vacation homes, second homes, and investment properties are going to be significantly impacted with cost, interest rate, somewhat synonymous with one another. The cost that they put in, which gets built into the interest rate, right? It's a cost. Well, I'm not too worried about a cost. It is, it gets built into the rate. And now your rate is sky high. Example, just a rough scenario, okay? And now this is going to change, right? And this, somebody over here can give an 8% better on the rates that you quoted, Eric. Well, look, it is what it is. This is just a rough scenario. $350,000 purchase price, 20% down, 25% down, in that vicinity. If you were going to do it as a primary residence today, you'd be at about 3.375. No discount points, no extra fees, no buy downs, no origination points, whatever you want to call it, whatever that fancy bank tries to disguise it as. None of that stuff, okay? If you were going to purchase the same property as a vacation home, you're looking at a rate of about 4. If you're going to purchase that same property as an investment property, you're looking at a rate of about 4.5. See where rates are going with and what they did with vacation home, second homes, and investment properties. Now we're being told that this is one of the things that they're trying to curb, temper, so that people can get into homes as primary occupants. They're trying to help curb the housing shortage that we have across the country, kind of deterring right? Or adding a tax, a significant tax, if you will, to people that are going to buy investment properties and vacation homes. So there's that. Expect it. Here it is. We've warned you. Now they throw this shockwaves across the industry by Fannie Mae and Freddie Mac. So we've warned you. Here it is. Second homes, vacation homes now even have higher rates. Remember before that a vacation home had the same exact interest rate as a primary residence. That day is done. Now look, we're kind of being told this is temporary, but I don't believe that, right? Anytime a government agency does anything, right, it's hard to retrieve. It's hard to go back later on, right? They implement a tax. The tax is usually there forever, unfortunately. They very rarely will ever take it away. So with that said, again, I apologize for the timing on this. It's been maybe a month since I've been out here. Some significant and important updates. You want any further details? Give me a jingle, 602-757-2171. With that said, it's Friday Coffee with your mortgage man, Eric. We'll see you.